Hello everybody and welcome to my second quarter 2023 conference call. Today's conference call is going to be a little bit different from normal. Usually I talk about the economy and the portfolio, but today I want to take a step back and talk about value investing more generally and why it has not been working well for some time. But before we start the main body of the presentation, I wanted to talk briefly about my own background. I started investing in 2004 after taking a finance course at university. And the first thing I did was day trading. So something completely different to what I do today. I day traded earnings announcements. And that was successful, but I had a full-time job back then and it was taking a lot of my time. And as a result, I developed my second strategy, which I ran from 2005 to 2014. I invested in microcaps, which are the stocks of very small companies, which are followed by only one analyst or even zero analysts. Again, this strategy worked well, but in 2014 I noticed that it was not working as well as before. And therefore I developed my current strategy. Today I invest in the medium-sized and large companies, using a combination of three different types of analysis. And we will be talking more about those analysis types later on. There are two schools of thought about investing. The first is efficient markets. This school holds that people are rational. There is a lot of competition in the markets, and as a result, stock prices are more or less correct at all times. In this scenario, the best strategy is simply to invest in index funds and not try to pick stocks yourself. If you want to learn more about this school of thought, then I recommend a book by Burton Malkiel called A Random Walk Down Wall Street, a very famous book. Then there is a second school of thought about investing called behavioral finance. And this school holds that people make mistakes. Sometimes stocks become too expensive and sometimes they become too cheap. And the intelligent investor can find the cheap stocks and invest in them and thereby beat the market. A good book to read if you believe in this school of thought is Intelligent Investor by Benjamin Graham, a classic value investing book originally written in the 1940s. Benjamin Graham had a famous student called Warren Buffett. Warren Buffett acquired a company called Berkshire Hathaway in 1965. And of course, today Buffett is famous because of his investment track record. Over the last more than 50 years, he compounded capital at Berkshire Hathaway at more than 20% a year, thus becoming one of the world's richest men. But even Warren Buffett hasn't had such an easy time recently. Here is the performance of Buffett's vehicle Berkshire Hathaway for the 5, 10 and 15 years ending 2020. And this shows that for those time periods, Warren Buffett underperformed the S&P 500 index. And it is not the case that Warren Buffett simply made a few bad investments. His investing style, value investing, had a difficult time in general. On this slide, I show two different ETFs, exchange traded funds. The blue line shows the performance of VUG, the Vanguard Growth Fund, for the past 20 years or so. And the orange line shows the performance of VTV, the value fund from Vanguard, over the same time period. And you can see that contrary to what you might expect, growth stocks outperformed value stocks over the past 20 years. Now you might say that this is only the past 20 years, and if you look at the past 100 years, then value stocks have outperformed growth stocks. And that is true. But I have been investing for the last 20 years, and it is a long time. And I think that in practical terms, it's not possible to underperform for such a long time period, for a couple of reasons. So first, if you underperform for so long, then it's quite likely that you will stop believing in your own strategy and you will stop investing in it. You will change your strategy. And also for anybody who works in the finance industry or wants to work in the finance industry, if you underperform for 20 years, then nobody will end up following your strategy. Or those people who follow your strategy, they will stop following your strategy. So I would say that 20 years is too long a time period to underperform. So when a strategy which previously worked so well, like value investing, stops working for a long time, then it's natural that people start to ask for explanations. And there's three potential explanations that I want to explore in this presentation. So number one is that markets have become more efficient. This means that there is now more competition than in the past in the value investing space. Then there is explanation number two, which says that value investing is just going through a random bad patch. And finally, there is explanation number three, which says that the problems that value investing has experienced recently are due to the low interest rate environment of the past decade. So, explanation number one, increased competition. So let's go back to Warren Buffett. On this slide, you see that in 1979, about 20 people attended Berkshire Hathaway's annual shareholder meeting. However, about 35 years later, that same number had grown to more than 40,000 people. And more than 3 million people watched the annual meeting on a Yahoo live stream in 2017. So what this means is that in the past 40 years, Warren Buffett and his ideas have gone from relative obscurity to the mainstream. Today, everybody knows about value investing and what it means, and how Warren Buffett made so much money in the past. And what this means is that there are more value investors today than in the past. I lectured a couple of months back at the university in Helsinki on their value investing course. And they use this course book on this course, where on the cover of the book it has this proud sticker saying that the book has sold more than 100,000 copies. So that is all well and good. Now the problem is that we know then that there's 100,000 people who know all about value investing, and some of them work today in funds where they have capital to invest. And that is what you see here. The assets under management in the hedge fund industry have grown massively over the past 10-20 years. These hedge funds, they hire some of the best graduates from the best universities. They have finance professors working for them. And some of the strategies that these hedge funds follow are based on value investing. So that means that there's a lot of capital today invested in the value strategy. And unfortunately, research has found that when a strategy becomes public and people start to put money to work in that strategy, then the returns from that strategy tend to go down. So here you can see that when a strategy is secret or not public, then you can make good money with the strategy. But after it's published, the returns go down, and after 15 to 20 years, they disappear completely. The value strategy was published in the academic literature in the 1990s. So more than 15 years have now passed since publication, and if we go by the last slide, then we could argue that by now all the profits from the value strategy have been competed away. That is perhaps not the whole story, however. There is another possible explanation, for the recent problems of the value strategy, which is randomness. If we look at the history of the value strategy over the past 200 years, we can see that there were many big drawdowns in the past as well. So today's difficulties are not unique. You had two big drawdowns in the 19th century. You had two big drawdowns in the 20th century. And then when Benjamin Graham and Warren Buffett made their reputations, there were few or no drawdowns. So that certainly helped them. Until recently, in 2020, we have a large drawdown. But perhaps it's possible that today is a similar time as, say, in 1904, when value strategy had done very poorly for about 20 years. But to stop investing in the value strategy at that time would have been a big mistake, because the value strategy rebounded strongly over the next 10-20 years. So these two explanations are the big ones, and you have to come up to your own opinion about which one is correct. If you believe that the markets have become more efficient, then perhaps it's not anymore worth investing in the value strategy, and you should invest in index funds. Or otherwise, if you believe that the value strategy is simply going through a bad patch, then it will still be worth investing in the value strategy. But now let's look at a third possible explanation, which is a more technical explanation, which only applies at certain times. And that explanation is interest rates. We all know that interest rates were low for most of the past decade. In the US, interest rates were about zero, and in Europe they were negative. And it has been found that value stocks do better when interest rates go up than when they go down. And there is a logical reason for that, because value stock indices tend to contain a lot of financial sector stocks in them, whereas growth indices tend to contain a lot of technology stocks. The typical financial sector stock is a bank. A bank benefits from higher interest rates because it can make more net interest income when interest rates are high than when they are low. Conversely, if you think about the technology industry, then it's hurt by higher interest rates because many companies in the industry are still unprofitable, and a higher cost of capital hurts these companies. So now we know a few possible reasons for why value stocks have done badly in the recent times. So the next question naturally to ask is, what can we do about that? Can value investing be saved? Well, it's not that every value investor has done badly in recent times. This is one example, my own performance from the beginning of 2009, which shows that over the past 14 years or so, my capital has multiplied by around 25 times. So how was this possible during a time when value investing in general did badly? So I'm philosophically a value investor, but I'm not a pure value investor. And there is no rule to say that you cannot combine value investing with other investment styles. And that is exactly what I have done, and I believe it has really helped me outperform over the past 14 years. So I apply a bit of macro analysis in my strategy. Then I do more traditional fundamental analysis, kind of traditional value investing with a computer program, also manually. But then I also combine technical analysis in my strategy, and as a result of which my portfolio turns over pretty quickly. And that has really helped my performance over the decade of the 2010s. Because the value investing strategy was the worst performing strategy of all famous academic investment strategies from 2010 to 2019. But at the same time, many other academic strategies worked well. So on this slide, you can see that while value investing didn't work, at the same time you could make money with strategies such as profitability, accruals, momentum, analyst revisions, and so on. So if your strategy combined many different sub-strategies, then you could make money even over the past decade. But if your strategy was a pure value investing strategy, then you probably had a problem. So there is this book called Super Forecasting, which basically says that when you are trying to predict difficult to predict variables, like for example stock prices, it's better to know a little bit about a lot of different things than a lot about a single thing. And I really believe in that philosophy. The second thing a value investor can do to make it more probable that their strategy will work is to invest in less competitive markets. When I started, I invested in the microcap segment of the market because I believed that there's less competition in that part of the market. It's been found that value investing tends to work better in markets where there's less competition, such as in the emerging markets. Then the third thing that a successful value investor should do is keep developing the strategy. Because if you come up with a strategy that is successful, that makes money, then other people will try to copy that strategy. And because of that, it's important to keep evolving. And that is the idea of this book by Andrew Lowe, an MIT professor. So what he says is that there is an ecology of market participants in the market, and that ecology keeps changing. And it's always better to be in places where other people are not. But the places where other people are not, that also changes from one year to the next. So you have to keep moving, you have to keep evolving. Finally, sometimes you just have to be patient. Growth stocks easily beat value stocks over the past decade. In part, I think that was due to bad luck. In part, I think it was due to low interest rates. But because of that, now value stocks have become very cheap compared to growth stocks. And because of that, I believe that there is a good opportunity today to invest in value stocks and to make better returns than growth stocks over the next 5 to 10 years. Value stocks have done badly over the last 10 to 15 years, but I don't think that's a reason to stop doing value investing. I think it's more the opposite. I think because value stocks have now become cheap, then now's actually a good time to do value investing. And I personally strongly believe that value stocks are going to be the place to be in the stock market over the next 10 years. Thank you for listening.